Hello and welcome to Financial Perspectives, a CFA Society San Francisco podcast where we explore trends shaping the investment and finance industry with experts in their field. This month, host Tanya Suba-Tang had the pleasure of speaking with Rachel G. of EY. Listen in as they explore the evolution of sustainability into a core financial discipline and how climate risk is reshaping decision-making across markets. Rachel, welcome to the show. Thank you so much for joining me.
Thanks for having me. Glad to be here.
So, as the Climate Change and Sustainability Services Manager at EY, I thought you would be the perfect person to talk about sustainability and climate risk for our Earth Day theme this month.
I'm so excited to be here and talk about that. It's a really fascinating topic and definitely a hot topic, that's for sure.
It definitely is. And, that's actually a perfect segue to my first question to you is that not too long ago, let's be real, hardly anyone in finance was talking about sustainability or climate risk, right? Now it's front and center. And I'd love to get your thoughts on what you think impacted this shift and what significant changes have impacted it over the past few years.
I think that's a really interesting question. And there are two core pieces to that, right? There's the what has impacted the shift, and then why has it? And really, why has sustainability moved to the center right now? If we really focus on that clear signal, I think, a perfect example is insurance. And when we pull back, sustainability has been at the center of finance for a while now. We just really haven't noticed it. But we saw it most recently in 2019 with kind of Hurricane Dorian, and there was a massive amount of damage to Florida. And what happened was a rise in premiums in Florida insurance, actually. And so what we saw is that the average homeowner in premium for the state of Florida kind of shot up, and private home insurance kind of withdrew. And the state had to come forward and not to kind of beat a dead horse about insurance, because who actually enjoys talking about insurance? But I think this was one of the most tangible examples of seeing climate and sustainability in finance, because how else do you think of finance except for pricing climate risk, right? Like, how else do you price it? So when we focus on that, it's kind of evolved from not just a values conversation, which I think is what most people think of sustainability as, but really a balance sheet conversation and how to price this. And not to think about this even more, but you also see this really in California too, right? Like wildfire exposure in California. There's been a global reinsurance repricing, and once these losses repeat, risk is always going to be repriced. So those are one of the things that kind of keep me awake at night. And before I even kind of dive into this, I have to caveat that these are my personal views and not the views of my firm. But I think in terms of market cyclicality, there has been a really big surge in sustainable investing and the interest around this as well. So across 2020 and 2021, there was a really huge growing interest in sustainable investing. And generally speaking, the trend of millennials and Gen Z, they're really driven by their values and they invest in a similar manner. But there's been a kind of familiar market cycle of early enthusiasm, capital inflows, recalibration, rates rise, expectations reset. These kind of things happen in a very cyclical manner. So this isn't like a new thing in many ways, I would say. And I don't know if you agree with me actually, but I'd love to get your thoughts on that.
No, I agree with you. I don't think it's a new thing, but you made some very good points with Gen Z and thinking and how now they're incorporating this into their portfolios and expectations. So, a quick question on that is, discussions about climate change, sustainability in finance, once it was discussed, was centered mainly on carbon emissions, right? Now they incorporate factors such as biodiversity, water risk, and total environmental impact on investment portfolios. How are you and your team adapting your investment strategies to address this broader spectrum of sustainability issues?
It's an interesting topic because I think when we think about sustainability and carbon, particularly, we've always kind of thought about carbon in silo. Carbon has always been the gateway metric. It's never been the end state. It's very easy to measure, it's easy to compare, easy to regulate. But this isn't a thing that has been in silo. And when we look back on kind of sustainability across the spectrum, and look at asset management in general, there's always been kind of the ESG component of it, right? Like governance has been a very core foundation of asset management. When you look at how they think about it, they would say that governance is what their sustainability program is kind of run off of. Whether or not you consider that greenwashing or not is a hotly debated topic. But when you marry that in with carbon and the broader biodiversity, nature, and water agendas, these things are systemic and they're like systems frameworks. So when water stress kind of shuts down operations across your entire value chain, that's not just an problem, that's a social problem and it's a governance problem. So, thinking about kind of climate change and sustainability in finance as, again, calling back to that bottom line and balance sheet problem, these things have now become a broader carbon was easy to measure, but now we're thinking about these as broad spectrum system challenges. And when we look at nature risk in particular, this becomes a really big financial risk. So, nature risk frameworks are really gaining traction. I think I have the TNFD, which is the Task Force for Nature related financial disclosures. I think in this past year, they've just really released the newest framework. 179 financial institutions are now reporting alongside TNFD. I think that's 25% of GSIBs are included in that reporting representation. There's a huge amount of nature related risk that's being kind of accounted for now because having exposure to the agriculture industry, when you think about how many banks and asset managers and private equity firms and even insurers kind of have exposure to that are underwriting the ag sector or even just forestry in general. And you think about mining and blue bonds or deep sea fishing, these are huge, huge industries and massive amounts of capital outflows and inflows that need to be considered when you're investing. And just kind of thinking, calling back to that insurance example I had a moment ago, I think the easiest example of this is real estate, actually. If you think of underwriting a high rise building in Miami nowadays, you have to account for massive amounts of sea level rise and like hurricane risk and flooding and whether or not there is even going to be the ability to get insurance in cities like that. So those are things that we're constantly thinking about when kind of advising clients and just generally speaking, considering the broader market trends of this. That's not to say that deterring people from thinking of real estate as a strong investment or whatsoever, but just generally speaking, when you look at the real estate industry, they are heavily thinking about the physical risks around their real assets because there are massive considerations for stranded assets and how you price risk, particularly from a climate risk perspective. I think there's just another really interesting component to that too, in terms of like revenue and structural demands for this, because again, this isn't just a risk story. There's a lot of upside opportunity to this. So there's a big thing around clean energy financing that's been really driving meaningful change. So if we think about kind of AI and data center buildouts, I think this is really reshaping our power infrastructure and grid at scale. And I think looking towards the future of this, AI it has massive power draw. It draws a huge amount from the grid. We know that going forward, we're going to continue using AI. That's going to be a continued trend. No one is going to stop using AI. I don't think anyone's going to argue with me on that. But at scale, you can't continue to say that we are going to use a finite number of resources to power this tool or this platform that uses the same amount of energy as a small metropolitan area in perpetuity. That's kind of defeats the purpose of finite resources. So, how can you use renewable energy to support this? And what we're seeing is a massive amount of investment, despite kind of political headwinds, blowing towards renewable energy because there is a strong demand for it. And you have to have this power infrastructure at scale to continue meeting consumer demand and business demand. So I think it's an interesting case study, right? That despite all of the changes, there's a growth story to this, an opportunity to make money in spite of kind of market headwinds.
Wow, thank you for all that wealth of knowledge and insights. I think you made some very, great points in how sustainability and climate really is impacting so many other sectors and branches, like you said, real estate and so forth. So, before I let you go, I did want to ask you if you had to venture a bold prediction, where do you see climate change and sustainability heading, in the next few years? Kind of just taking what you said and how much of an impact it really makes in other decisions. What is the next iteration of that? What do you think is going to be happening in the future?
Oh, well, I think there will be kind of two big parallel trends. Sustainability will get quieter in terms of market headlines or big, bold news headlines, but it will become very embedded in your BAU. There's going to be less branding, but more integration into, say, your credit committees, your underwriting, your asset allocation. You're going to see a shift from a sustainability strategy into just strategy. Secondly, I think you're going to see kind of a risk mitigation budget growth, essentially. So, most North American businesses have experienced kind of material weather related losses in the past year alone. This is driving true spending on physical risk mapping, supply chain resilience, and long term capital planning. So, you think about how this has impacted their supply chains. There's going to be a real investment in kind of weatherproofing those, for lack of a better term. And I think the other thing, regulation is going to be messy, but directionally it's going to be really clear. The timing and scope across jurisdictions will ebb and flow. That's always kind of been the case. You've seen it in the 70s with the Carter administration. You've seen it year over year across every administration. It is super cyclical, but the expectations around what these regulations globally are driving will essentially remain the same. And I think that's why many organizations will continue doing this long lead time work. So, scope three, scenario analysis, data digitalization, even amid this uncertainty, that's going to continue remaining a long term investment. I think companies will continue investing in data. So you've seen like incredible amounts of satellite imagery data. There's some really, really cool data, third party vendors that do awesome scoping activities around like how to calculate carbon on trees and like in the water and in the forest and what the water level is for ponds in the middle of nowhere. It's very interesting. They have can like count people in the middle of Thailand. Like there is satellite imagery for geospatial awareness. These things I see a massive amount of continued investment in third party vendors to continue driving this because you can't make strong decisions without good data. So directionally, I think that's where it's going, despite headwinds in regulation and the cyclical nature of that. Organizations are going to continue investing in their data, in kind of building out the pipelines to deliver on regulation when it comes, because no one wants to be caught on the back foot and reactive to regulation when it lands. So kind of in summary, I think sustainability in finance is no longer really driven by enthusiasm and this kind of rah view that we've always had. It's not driven by regulation alone anymore, but it's really shaped by opportunity because there is upside to this and this risk mitigation and like a need to operate globally. So the cycles will always continue. I think the noise will always be there, but there is definitely an underlying shift in the sustainable finance market and It's exciting to see a change from an externality, I would say, to an input into our bottom line. So I'm excited to see what the future holds.
Well, thank you so much. Thank you again for all the insights you shared. I know our listeners are going to take it all in and appreciate it. And I hope we'll have you back in a couple of years and you can give us more updates and see if any of your predictions come true.
Hope they do. Thanks for having me.
Thank you to this month's guest, Rachel G., for joining us to share her insights on sustainable investing and climate risk. Be sure to join us for another episode of Financial Perspectives, released on the last Tuesday of each month. This podcast is produced by CFA Society San Francisco, a not-for-profit professional association providing professional learning and career resources to over 13,000 investment industry professionals worldwide. To learn more about CFA Society San Francisco, visit our website at cfa-sf.org or connect with us on LinkedIn.